Okay, dear students, we're going to finish our discussion of bonds with two very important topics: yield spreads, the yield curve, and valuation, bond price valuation. And we're going to see something that should look fairly familiar. So let's get started on slide 20 with yield spreads. Yield spreads are the differences in interest rates that exist among sectors of the bond market. In general, the, the shorter the maturity, the lower the rate. And the longer the maturity, the higher the rate. Well, this makes sense. The longer money is out there, the more opportunities for things to go wrong, right? And of course, the higher the rating of the bond, the lower the interest rate, and vice versa. Just as when people have a very good credit rating, credit score, they get better interest rates than people with bad credit scores. Treasuries carry the lowest rates, next are muni bonds. General obligation bonds generally pay less than revenue bonds, but as we discussed, some savvy bond investors really love those revenue bonds that are, pretty solid and can pay the revenue from the bridge or the water authority or whatever. And then corporate bonds, of course, yield the highest rates. Non-callable will yield less than callable, but non-callable is definitely a desirable feature in a bond, so they can't pull it away from you. Here are the bond spreads for October 24th, 2024. Thank you very much, Fidelity. And putting in a plug in for Fidelity, they tell you that they will, if you get an account with them, of course, give you the quotes on thousands of bonds. Very cool, because if you checked Chapter 8, you saw that using FINRA for your bond quotes wasn't the easiest or very most reliable thing to do. So here you are with Fidelity. Fidelity is a very good marketing organization, folks. They've been around a long time. And they're run by the granddaughter of the person who started it. So check it out. Check it out. And we notice that rates have definitely gone up before, after the Great Recession, rates fell to unbelievably low levels. And then 2022, they've gone up. They've actually gone a little bit down since then, but it's still bonds are back. Look, especially if you go with triple B. Look at that. That's a pretty darn good rate for those corporate bonds. And muni bonds are paying pretty well, and treasuries are paying. I don't know. I just can't get excited about a treasury bond paying 4.5% for 30 years. I mean, it should beat inflation, but not by much. Often investors will speak about the bond spreads as being tight or wide. A tight spread means the interest rates amongst the bonds they are evaluating are very close to one another. So you get a treasury paying 4.8%, corporate bond paying 5.1%. That's 0.3%, or what you'll hear in the industry is basis points. 30 basis point. Every basis point is 0.01. And you hopefully caught that way back in chapter 3. A wide spread means there's a big difference between the bond interest rates. Treasury paying 3.2, corporate bond paying 8.2. That's 5% or 500 basis points. In the first example, I'm pretty sure I'd probably take the treasury. In the second example, I might say, that corporation is a good corporation. I believe they're going to pay those make their payments. I'd definitely take that 8.2%. During the turmoil of 2008 and 9, the yield spreads widened to levels not seen in decades. There was a flight to quality. People ran to treasuries because they believed that the United States government wasn't going to go anywhere. But they dumped all their corporate bonds and muni bonds. We saw the Ford and the Poway school district bonds just get hammered. They narrowed significantly during the 2010s after the Great Recession and have somewhat widened again since 2022 when interest rates went up because of the Federal Reserve Bank pushing short-term interest rates, and long-term interest rates went up. Experts in the media, as we say, use the term basis point to signify 0.10% of a percentage. 0.01 of a percentage, so that's 0.01%. So 100 basis points would be 1%. So just get used to that terminology because you're going to hear it. Slide 23. The yield curve is a graph that represents the relationship between a bond's maturity and its yield at a given point in time. It's also used to make comparisons among types of bonds. Normally, the yield curve is upward sloping. This is called a normal yield curve, upward sloping. Longer term bonds have interest rates that are higher than shorter term bonds and treasury bills. Sometimes, though, it's unusual, but sometimes the yield curve is downward sloping, and this is called an inverted yield curve. Shorter term bonds and bills have higher interest rates than longer term bonds. Huh? I don't understand. That doesn't make sense. We'll see what that can signify. Slide number 24. Here is what the magenta, I guess that is, so kind of like a purple. That's typical. Shorter term rates have lower interest. Shorter term maturities, treasury bills and 2-year notes, 5-year notes, 10-year bonds, 20-year bonds, 30. They start off lower interest rates and then slope upward. But sometimes we get a situation where we have a downward sloping, an inverted yield curve. That doesn't make sense. Hang on a minute. Stick with us here for a few slides here. What are some of the theories regarding yield curves? Why do longer-term debt securities, bonds, notes, treasury bills, treasury bills are very, very short-term, normally have higher interest rates than shorter-term debt securities? Well, there's a few different reasons that are posited, that are brought forth. The expectations hypotheses. The shape of the yield curve reflects investors' expectations of future interest rates. Well, that makes sense, right? It's all about the future. There's the maturity preference hypothesis. We call this the liquidity preference, and this is just as you have to come up with a fancy name for it just makes sense. Investors tend to prefer the liquidity of short-term securities and therefore require a premium to invest in longer-term securities because there's more opportunities for things to go wrong, and if you're going to get your money sooner, you'll take a lower interest rate. If you're going to get your money longer, well, I want a higher interest rate. And then lastly, the market segmentation hypothesis, which says that the market for debt is segmented on the basis of maturity. Supply and demand curves within each segment determine the prevailing interest rate. Well, that makes sense. Yeah, I and a bunch of other people need this money in 5 years, and there's a bunch of people who are selling bonds that are 5 years old, so there's a supply and demand dynamic in that 5-year as well as the 10-year as well as this one. So each of these three theories makes sense. Each has some merit. But how do we account for the times when the yield curve is inverted? What factors could cause an inverted yield curve to occur? And what can the yield curve tell us about the future of the economy? Well, since World War II, every time the yield curve has inverted, where short-term rates were higher than long-term rates, the economy has fallen into recession. There was one exception in 1966 where the economy hit 0% growth, didn't go negative, but it didn't fall into a recession, and short-term interest rates were higher than long-term interest rates, and then they evened out. The yield curve inverted in 2019 ever so slightly, causing renewed fears of an imminent recession, but then reversed strongly as the virus turmoil hit and the Federal Reserve knocked interest rates back down to 0. For about 2 years before the beginning, For about 2 years before the beginning of 2008, the yield curve was slightly inverted. The bond market was predicting a recession for over 2 years, but the stock market, for the most part, didn't believe him. And this, of course, was in the heyday of the housing bubble. It wasn't until the fall of 2008 that the officials charged with tracking the economy acknowledged, oh yeah, we're in a recession, and it's going to be a doozy. It took over 2 years, but the bond ghouls, as they're often called, were finally proven right. The yield curve has been inverted for 2 years. What's a recession ahead? Stay tuned. Now, why would they be called the bond ghouls? I don't like this term, and I don't hear that many people use it anymore, but I used to hear it a whole lot before. That's what they were called. Well, what happens in a recession? Well, stocks get hammered, of course. Earnings get destroyed. People lose their jobs, but interest rates fall. Right? There's less of a demand for money. The Federal Reserve knocks down short-term interest rates to stimulate the economy. And what happens when interest rates fall? Bond prices rise. Now, I don't think bond investors as a whole are happy about a recession, but they often, and I've heard this saying, I like it, they often think of their bonds as airbags. When the economy hits a crash, the airbags go off and protect you because the bond valuations often go up. Now, in the Great Recession, Treasury bonds went up. The interest rates fell dramatically, but not so for corporate bonds and even some municipal bonds, as we saw. So it's not a done deal. It's not, right? So let's take a look at the yield curve in 2019. Here it is right here. This is from Guru Focus, which is actually a pretty cool website. Check it out. In 2019, here's 2020, right? And that was 2021. Notice these were upward sloping. But in 2019, the yield curve was slightly inverted. There, the short term, 3-month, 6-month, were higher than the 3-year, 5-year, and even not quite the 10-year was a little bit higher. So that there was much talk of a coming recession during 2019. Many experts, though, were quick to point out that the yield curve could be inverted for quite some time, as we saw 2 years before the economy fell into recession. But then COVID came onto the scene, and both ends of the yield curve collapsed as the Federal Reserve lowered short-term interest rates back to zero. Bond investors braced for a pandemic-induced recession, and stock investors. Remember, it was the fastest bear market in history and the fastest recovery when we realized that, oh yeah, the world's not going to end, but a lot of people are going to die, and a lot of people unnecessarily died because of the efforts or non-efforts of a certain... Well, I done to slide 29. Here's the current Treasury yield curve. And notice it's been... So this is... Here it is right here. The blue one with this guy. You see shorter-term interest rates are higher than longer-term interest rates. And back in 2023, the one at the top, notice the interest rates have fallen a little bit since last year. It was inverted. 2022, it was kind of messy. It was shorter term were lower, and then it inverted a little bit here, but not much. So the yield curve is currently inverted. As mentioned, when the yield curve inverts, the investment world begins to worry about a coming recession. Are we heading for a recession? Well, we'll see, right? Stay tuned. But remember, keep a long-term perspective. Recessions come and go. Focus on high-quality companies with growth and income prospects. And whatever you do, don't panic, because if the world does end, it doesn't matter where your money is, right? Yeah. I don't want to get into politics here, but it could end. We got people who are enamored with their nuclear weapons here. Slide number 30. So that was the bond yield curve. And you need to know this because, remember, you're the official investment guru for your friends and family. And you need to, when they come to you and say, I just heard we're going to have a recession. Somebody said something inverted. You're going to say, relax, relax. Yes, that's been an indicator in the past 80 years or so. But it's not a guarantee, and it does take time. And we don't even know how bad it's going to be. So just think about the long term. All right, now, also, when there's a recession, right, it's a great time to buy. Of course, who wants to buy when prices are falling? Slide number 30, bond valuations. Bonds are normally priced according to the present value of their future cash flows. Are you getting sick of hearing that term, present value of the future cash flows? Well, yeah, it's the discounted cash flow model all over again. Semi-annual interest payments and the repayment of the principal. So instead of dividends, now we're getting interest payments. And instead of predicting some future stock price, which we know is going to be wrong, we know, unless the bond falls in default, that we're going to get our principal back. Although other factors will always need to be considered, such as the credit worthiness of the issuer. If an issuer runs into trouble, right, Ford and Poway School District, the price of their outstanding bonds will fall because investors will be dumping the bonds. They're afraid of default. So here's the formula. Bond price equals present value of the interest income and the present value of the repayment. Yeah, it's the discounted cash flow model. Now, we're going to use the present value tables. And I know some of you would rather eat barbed wire than use the present value tables, or maybe you didn't even watch the presentations where we showed you the present value tables. But the formula for this one, the exponential formula for the interest payments, is a whole lot trickier, folks. So I show it to you in the spreadsheet that we're going to see. I guess I'll show you the spreadsheet in the presentation, but there's another presentation that describes the spreadsheet. Okay, so we're going to do the present value of the interest income, and we're going to add to that the present value of the repayment of the principal. Now, should we do annual or semi-annual compounding? Since bonds pay interest normally every 6 months, we really should use semi-annual compounding. But annual compounding is much easier and will give you almost the exact same answer. And as we saw in chapter 4, once we've learned how to do these manually, then we go to the spreadsheet and it does it for us. Spreadsheets make life so much easier. So here's an example here. And we chose this because of certain attributes that we'll discuss in just a moment. American Electric Power. Notice they're rated BB. I think it's BBB. I'm sorry, BB. I don't think it's BB minus. I got to go check. I thought it was BBB. Anyway, it's still one step up from junk, right? They're paying 5.9%. That's, $59.50 every year. It's actually half of that every 6 months. And they're due in about 8 years. That's why we chose it, because it's about 8 years from now. And it's priced to yield 5.04%, and that's why we chose that, because it's very close to 5%. The tables only work on integer, whole numbers, interest rates, and whole number years. So the current yield, 5.627%. You can do that calculation from what we learned in a previous presentation. So now, how do we do this? Well, we take the present value of the interest income and we add it to the present value of the principal repayment. Well, remember, it's 5% for 8 years. We don't use the coupon yield, the nominal yield. No, we use what it's priced to yield. So let's go over to the table. Here's the present value tables right here. And this one is a little tricky because you can't really see it. You can't see the years on the left-hand side. I guess I can make it smaller, but that'll even make it even harder for you. We go across to 5% and down to 8 years. And that's 8 years right there. I'm not going to show you the 8, but you can see the 8 over here, right? You can see the 8 over here. 6.463 is the present value multiplier. 6.463. So we multiply the $59.50 times 6.463. And that's equal to about $384.55 or so. So in other words, we're going to get $59.50 for the next 8 years. What is it worth to us today? What's the present value? How do we discount that stream of future interest payments back to the present? I know the words sound really bizarre. My apologies, but get used to them. So $384.55 or so. That's what that $59.50 over the next 8 years is worth to us today. Now, what about the principal repayment? Remember, some bonds are $5,000, $10,000, but let's just stick with $1,000 bonds. $1,000 times the present value multiplier for 5% for 8 years. Well, this is the table that we used back in chapter 4. Go across to 8%, down to, 5% for 8 years. 5% for 8 years, 0.677. And we find that that $1,000 in 8 years is worth to us today $677. Add the two together and you get $1,061.55. So the quoted price on the October 25th was $1,057.42. Very close, right? The bond calculator gives us $1,058.82 for annual payments and $1,062.67 for semi-annual payments. Why are they all pretty close? Because bonds are fixed. Yeah, unless there's a default, we know what we're going to get, so we should expect to be the predictions to be very close to the valuations, and that's exactly what we get. Now, why is the semi-annual prediction from the semi-annual payments higher than the annual prediction? Well, think about it. We're getting not 50, we don't have to wait until the end of the year to get $59.50. We get half of that after 6 months, and then we get the other half after another 6 months. So that's why it's worth a few more dollars. Now, let's go take a look at the spreadsheet, because those of you who really want to do the exponential formula, I'll show you where you can find it, folks. Oh my goodness, it's so small you can't even see it. But if you click on this guy right here, you click on that guy right there, there's the, and it's up here. You can't even see it. You have to go look at it. I can't even get it to. I don't want to mess with it because it'll mess up the presentation file. But there's the formula, and it's a little tricky. And then if you want to do semi-annual payments, it's even a little trickier. But those of you who are math savvy, you'll say, "Oh, I can figure this out." Yeah, cancel. No, leave the site. I didn't change anything. So that's how we do them. So now this is in the face-to-face class, just as we would, stop for the other interest calculations. We would stop and do the worksheets now. So you're going to do those, right? Make sure you do number 3 several times, because it, hint, 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 might look something very similar to what's on exam number 4. Okay. Slide 33. Reinvestment risk. Now, these last attributes and characteristics of bonds, they're something you will read about maybe a little bit and just forget about. But the first one is something I hope will reinforce the idea that we need to think long term. Reinvestment risk is the uncertainty about the future value of an investor's bond investments that result from the need to reinvest bond interest payments and redemptions at yields not known in advance. So let's think. If you're just using your bonds to live off of, you're paying, the interest payments are coming in, you're using them to live off it and live off of them, and then when the bond is repaid, you turn around and buy a new bond, all right, or maybe you just use that money. It's not as important to you. But if you're using your bonds to build wealth, to build your nest egg, this is something you need to think about. Changing interest rates don't only affect the price of your bonds. They also affect your future income, as you need to reinvest the interest income in bond repayments. If interest rates have fallen, yippee, right? Yeah, bond prices have risen, but now your income level in the future will fall as you reinvest your income and your bond repayments. You see that? It's a two-edged sword. Sure, my bonds are worth more, but now when I go to buy new bonds, right, they're paying less. Likewise, if interest rates falling, oh boo, my bonds are worth less. Well, although bond prices have fallen, your future income level will rise from reinvesting in higher paying dividends. So this is yet another example, folks. We stress so much in stocks, but we also need to think about it in terms if we're using our bonds to build our wealth. It's yet another example of why it is important to keep a long-term perspective. Sure, interest rates fall, your bond prices rise, but now you're going to get less interest from new bonds. Interest rates rise, oh, my bonds have fallen, but now new bonds are going to pay us more. Right, yeah, okay. Take a long-term perspective. Now, what's this duration thing? It's something that, most 99% of us are not going to worry about unless you got a ton of money and you probably then you're buying individual bonds, but you have a personal broker and hopefully they understand duration. This is a measure of a bond price's sensitivity to changes in interest rates and bond yields. It captures both the price and the reinvestment risk that we just discussed. It's used to indicate how a bond will react in different interest rate environments. The duration of a bond changes as it approaches its maturity date and current interest rates change. So in general, the longer the bond's maturity, the longer its duration. Think of it like the maturity right now. The higher the bond's nominal rate and yield to maturity, the shorter the duration. The shorter the duration, the less potential price of volatility and vice versa. But how many of us are going to build a huge portfolio of bonds? They want $25,000 as a minimum purchase, $100,000 typical. No, it's not typical. Unless we buy treasuries. Treasuries at Treasury Direct? Yeah, sure. Now, slide 35. Investors who have a specified time horizon can use what's called bond immunization, oh boy, to increase the probability of successfully achieving their desired goals. Keep the average duration of your bond investments equal to your time horizon. You would thus be more protected against interest rate induced price swings. So say you got a 5-year time horizon, right? So you keep your bonds at a 5-year duration, the best you can. Well, what's the problem with this? It requires constant rebalancing of your bond portfolio since durations of bonds change as interest rates change and bonds get closer to maturity. Now, who's going to use this? Not you and me, no. Bond mutual fund managers, pension fund managers, life insurance companies, people who deal with millions and billions of dollars are going to be worried about bond immunization. Because if you have an intermediate term bond fund, right, their job is to make sure that they're intermediate term bonds. The duration is 3, 4, 5 years. If you have short term, 2, 3 years, long term, 7, 10, 20, 30 years. So they have to worry about this stuff. Now, lastly, we're going to discuss some investment strategies and then take a look at what's called bond laddering. There are 3 basic strategies when it comes to bonds. There's the income strategy, where you purchase the bond simply for the interest income that they produce and live off the interest. There's the capital gain strategy, that you are speculating, whereas that word means gambling, right? That interest rates will fall, or you're dabbling in distressed junk bonds and hoping that the credit rating rises, or the stock market, the economy does well, and junk bonds tend to do well with the stock. They tend to follow the stock market. We'll discuss that in a couple future chapters. Correlation, it's called. We'll discuss it in a little bit. Now, total return is obviously a mixture of the both, and you will see bond funds called the PIMCO Total Return Bond Fund. So they're trying to do both, right? Or you'll see a bond fund, the income strategy, the income bond fund, the bond fund of America, income fund of America, that kind of thing. Well, they also invest in stocks, so that's not a good choice. My apologies. But bond income fund. You might see a opportunities bond fund or some kind of like that name, like that, or read in the prospectus that they're trying to game the system. They're trying to speculate, and I would stay far away from that, in my humble opinion. That's not why we buy bonds, folks. We buy bonds for stability. So the easiest to implement is obviously the income strategy. The hardest is the capital gain strategy, and the total return is somewhere in between. Slide 37, bond laddering. Now, what is this? Well, this is just another example of diversification. You purchase bonds with staggering maturities, some 2 year, 5 years, some 10 years, some 20, 30 years. Purchase some bonds with short-term maturities, some with intermediate term, and some with long-term. Very popular with pension funds and bond mutual fund managers since they have considerable sums of money to invest. What are the advantages and disadvantages? Well, the advantages is that you're diversified. What's the disadvantage? Well, that you're diversified. Huh? Yeah, right. Diversification is sometimes a very good thing, and I think it's a very good thing all the time. But other times you go, oh man, if I had just loaded up on long-term bonds and interest rates fell, I would have made it. Well, just forget about it, all right? Trying to guess what's going to happen in the future, we know is very, very difficult. And so some people will poo-poo diversification, and we're going to get that. We're going to, as we said, I'm getting ahead of myself. My apologies. But in chapter 11, we're going to tie everything together and discuss diversification, asset allocation, correlation, and all that good stuff about diversification. But we're going to see that some people just, they don't like it. They don't want to use it, and that's fine. That's their choice. I think they're playing with fire, and they might get burnt, but they might do really, really well. So who am I to say anything, right? Who am I? Slide number 38. Here was the investment, the interest rate spectrum just a few years ago, 2021, before interest rates started rising. Look at those 3-month, 6-month treasuries. Yeah, they're now. Well, they were 5% for a while. Now they've gone down to 4.5, 4.7% for, yeah. And then look at that. 30-year bonds, 2%. I mean, why would anybody buy a 30-year bond at 2%? Inflation rate over the last 80 years averaged around 3%. You know you're going, anyway, forget it. That was their decision. And then what happened in 2022? Aha! In April of 2022 is when the inflation started to take hold and people started to freak out, and the Federal Reserve Bank started raising interest rates. We knew it was going to happen. We just didn't know when. We knew interest rates were going to come up. We knew that the COVID closure of the economy was going to spark some inflation. The experts were calling it hopefully transitory. Oh, it wasn't transitory, yeah. Because when you shut down the economy, when you bring it back open, it just doesn't, it's not like flipping a switch. All these supply-demand imbalances occur, and that's what caused that terrible inflation. And it really wasn't as bad as we make it out to be now, if you compare it to the 1970s or other times when other countries have had really bad inflation. So that was 2022, and now here is, hello, sweetheart. Go to the next slide, please. Thank you very much. Here's where we are now. 3-month Treasury, 6-month Treasury bills have fallen from over 5%, which is what they were when you started the class, weren't they? Right? You were finding, oh, they've already gone down quite a bit. And now you can get a 30-year Treasury bond for almost 6%, which is, bonds are back. In fact, if you're willing to pick a BBB, I think it was close to 7%, which some people would say, hey, let's do some research on that company and make sure that they're not going to go and belly up. And would you be happy with 7% bond for 30 years? I think a lot of people would be. So as one bond fund manager said in a presentation I saw, bonds are back. And that for bond investors, that's a good thing. But 10-year Treasury was down below 4. It's back up about 4. What's going on now? There's a little bit of uneasiness. I think a lot of it has to do with the election, so we'll see. And also Putin and Ukraine and Israel and Gaza, and the world's in a terrible state of chaos. And so that, dear students, was our discussion of bonds. Boring bonds, stodgy bonds, reliable bonds, yes. So now we're ready to take a little detour into the backwater of the investment world, and those are hybrid securities, preferred stocks and convertible securities. We'll burn through it quickly. There's only a few questions on the exam, and I will give you the questions and their answers. So some of you might say, whoopee, I don't have to go through the presentation. Well, I hope you do, because you're the investment guru for your friends and family and coworkers. And when they come up to you and say, well, why should I only buy common stocks? Doesn't it make more sense to buy preferred stocks? And you're going to say, no, not really. And you're going to explain to them why after learning about it in the next presentation. Thank you so much for being in our class, dear students. We are so proud of you. Think of how much you learn. The industry needs you. You are now the official investment gurus for your friends, your family, and coworkers, and you are bringing honor and glory to them and to you and to Southwestern College, and we're so proud of you.